with this. Is it a tax aggressive strategy to crystallize a gain before June 25? That might have been a question, but the CRA has provided commentary already indicating that a transaction aimed at taking advantage of the 50% inclusion rate would not be viewed as aggressive and subject to the general anti-avoidance rule in and of itself. Now, if it's part of a greater planning and there are other elements that are more aggressive in the rest of the planning, it's possible. But in and of itself, to trigger a gain at 50% would not be considered as something aggressive. So that's good to know.
It's interesting because it's not that common that they give you the time. You know, when they propose a rule, in this case, they gave us a couple months to figure out if we wanted to trigger gains. So
exactly. And that's exactly the CRA's rationale in providing this technical interpretation is that, you know, when they announced the rules, they gave that planning period. So if you take advantage of it, it can't be viewed as aggressive because otherwise they would have put the cutoff like on the date of the announcement.
Right. So. Okay. Well, that has to be the number one question people are asking. Should I do something before June 25th? While we're here together, I was just wondering, what do you see as the kind of most problematic situations for people where this is going to actually have the biggest impact? You know, I think of upon death, maybe, or...
Yeah, upon death, that's definitively a very good one because it's not uncommon to have very significant gains upon passing because all the gains are realized at the same time. So it's quite easy to exceed the $250,000 personal exemption or limit for the 50% inclusion rate. I think also people who are leaving Canada, or because we have a little bit the same mechanism upon departure from Canada, which is an acceleration of all latent capital gains. And add on top of this also the AMT, which is applicable in the case of departure. It's not applicable upon death. But still, so those are situations that are problematic. Sometimes people can plan around the new rules. So, for example, what's going to become very valuable is the personal limit of $250,000 annually of gain at 50%. So sometimes you can plan to realize your gains over a number of years. So, for example, if you know you're going to need money from your portfolio to purchase real estate, but it's a project that you have for 5 years down the road, you may want to realize gains every year and stay below the $250,000 threshold rather than liquidating all the portfolio at once. But sometimes you can't do that type of planning. Again, the sale of real estate is one where you don't really have that flexibility. It happens at one given point in time. So those situations are problematic.
I wondered if I could ask you, when it comes to trusts, because trusts don't have the $250,000
correct
space to benefit from. If they allocate the gains out to the beneficiaries, is that a way that they can plan a little bit?
Yes. So what the rules have mentioned, for what we know now, is that the gain that is received from the trust will still benefit from that $250,000 limit.
Okay. Yeah. Great.
Other maybe planning tips. So we were discussing, okay, is there an opportunity for me to do a crystallization? Let's say the answer is yes. You want to move ahead with this, but at the same time, you're very cognizant of the uncertainty about this new environment. So one way to keep the door open is, for example, to transfer the asset that has the accrued gain that you want to trigger, let's say to a corporation on a rollover basis. So because you file a tax form which is due only later, not at the time of transfer, but only later, and it depends on the year end of the parties involved. But at least until you file that form, you don't have to make a decision. You could trigger the gain upon rollover, but you could also do a tax deferred rollover. So you keep that door open. So
That's interesting. Yeah.
proceeding by way of rollover can allow you to initiate something, but give you the flexibility to see how things will evolve also. So that's one thing to keep in mind. We were also talking about, the situations where these rules are most problematic, and you identified death tax as being a situation like this. It's a good opportunity, I think, for clients to revisit their life insurance coverage and plan the funding of death tax. Also, maybe some estate planning strategies will need to be impacted. The pipeline strategy will become a little bit less attractive. It will still be interesting, but it will not be as efficient as it used to be, because that's a strategy that's based on liquidating a corporation at capital gain rate. So if capital gain rate goes up, that strategy becomes a little bit less efficient. So that will also change a little bit the parameters, the factors that we consider in designing post-mortem tax strategies. One other thing also in terms of planning ideas. So we were talking about the fact that the $250,000 exemption personally will become very important, and corporations don't have that. So for example, if you have a client that has a holding company that is sitting on some CDA or some RDTOH, you may want to consider to extract corporate funds and bring them personally, if the tax cost of doing that is not too high, and start having a portfolio personally, so that you can realize some gains personally at the 50% inclusion rate, rather than doing everything in the corporation at 2/3. So that's another thing to keep in mind.
That's very interesting. On that CDA point, people who are used to taking from their CDA for living expenses or revenue, now they're going to have a smaller portion, right, available in the CDA.
Absolutely. Yeah.
So it's going to be a constant kind of cost now to catch up to being able to extract, I guess, if you're specifically using the CDA.
Correct.
But maybe
you're absolutely right.
Yeah.
There were some small good news in all of this for business successions.
Yes.
With the increase of the capital gains exemption on qualified small business corporation shares, which is currently at $1,016,000 roughly. It will go up to $1,250,000 as at June 25, 2024. So for people who have tax strategies that are relying on the claim and the multiplication of the capital gains exemption, through the use of family trusts, for example, that is good news. Especially, we said when we were talking about AMT that AMT was an important planning point when we consider multiplying the capital gains exemption through a family trust. With the new rules, the AMT burden upon allocation of capital gains exemption to a family member is lower. So so that's also something that's interesting when we compare to the AMT pre-2024. So for exit strategies based on the capital gains exemption and its multiplication, there is some positive. Another thing also that was announced, I don't know how useful it will be, is the Canadian Entrepreneurs Incentive.
Yes. It sounds like it could be interesting.
It's an additional planning tool, so we're not going to disregard it for sure, but it's very narrow. It starts in 2025. At the beginning, it's starting rather small, right? It's $200,000 of gain that can benefit from that treatment. The treatment in question being you benefit from 50% of the inclusion rate. So your inclusion rate goes from 2/3 to 1/3, essentially. So at the beginning, it's starting very small. So it's not necessarily going to make a very big difference, but it's increasing to reach up to $2 million per person. But that will take until 2034 to get there. So that's long. Many things can change during that period of time. But it's just another tool to keep in mind. It could be useful in certain circumstances, and it would become more and more useful as the years go by if this measure is maintained.
Yes, it really, I mean, we can understand why they've proposed these rules, but we can also see that there's a lot still that they kind of need to iron out, figure out, decide.
Absolutely.
Yeah,
Absolutely. And when they released the budget, they indicated that only a very, very small number of taxpayers would be impacted by this. But it
it's not
seems to
true.
me that these numbers are really understated. I think these rules are impacting a lot of people, especially in the context of death taxation, where I think it's something that can apply to a very large number of taxpayers. So it's definitively a major game changer when it comes to tax planning. Probably one of the largest changes that we've seen in the past years.
Yeah, and lots of people don't know. I'm so glad you mentioned the fact that the capital gains inclusion rate has been different. Throughout history, we have
Yes,
seen different levels. So
yes,
it's not like it's always been 50% and now all of a
right,
sudden it's right.
right.
So having that context, I think, is very relevant. Also to say that this isn't necessarily the last word. We don't know. Things can evolve for
For
sure.
sure, for sure.
For
And
sure.
and there were lots of reactions, obviously, when these changes were announced. Uh, Mostly negative, obviously. Is that going to impact what will end up being implemented? We have seen in the past the current government change their mind on some tax measures. In the summer 2017, 2018, they had announced a series of measures impacting taxation of private corporations and business owners, and they changed their mind. They kept some of them, but they put aside some of them also
Yeah.
because of the pressure that was put on the government to review its position on this. So it is not impossible that there would be changes compared to what has been announced so far. So
Yeah. I
stay
even
tuned.
think of the professionals, who over the last decade have had the privilege of incorporating and earning money through a
Hmm.
corporation, who are now, a lot of the benefits of that, or not a lot, maybe, but in this particular instance, the benefits of triggering capital gains in a corporation are a lot less favorable than doing it
Sure.
personally.
Yeah,
So,
yeah. It's really something quite unique to have this difference between the capital gain treatment for individuals and corporations. Uh, that I think it's definitively was not the case before, because there was always this integration principle according to which we
right.
wanted to have the same tax treatment for individuals and for corporations. In practice, it was not perfect, but there was this intention of achieving this goal, and now we're completely departing from this goal and going in a different direction and favoring individual taxpayers, which is very different from the tax policy of several previous years.
Yeah, it's interesting. It's definitely a change in trend.
Yes,
Well, I thank you. I don't want to take up too much of your time, but I hope that we can perhaps have another conversation as things evolve, as we
sure.
see clearer, the impacts of these and see the types of planning that does take place. You're so brilliant and so insightful. And I was even thinking, la prochaine fois, on pourrait le faire en français.
Avec plaisir. Ça sera avec grand plaisir. Thank you so
Uh,
much for having me today. It was a pleasure and a privilege to be with you today.
you're amazing. Thank you so much, Isabelle.
Thank you so much. Have a great
See
day.
you soon. You
Bye
too.
bye.
Bye.